Good morning, everybody. It's Friday, January 25th, 2008. This is Matador from freetradingvideos.com. Just wanted to do a little talk about some gaps. Some people in our forum had asked about that, and so I wanted to just talk about normal gaps, exhaustion gaps, catastrophic gaps, and even some continuation gaps. So just a quick glance at the S&P 500 today so far. It's about 11:23 a.m. here, and like I mentioned yesterday in a video, it's a pretty good retracement of the sell-off. So nice big move down to the downside, nice little bounce now, 4 days in a row. It is past the 50% retracement. Again, that makes a little bit better chance that we form a higher swing low here and start working our way out of this. And of course, the market could rebound from here and go straight up, but again, there's a lot of overhead resistance to fight into. That being said, I picked a few charts to go through just to talk about this. Some normal gaps, and you can pick almost any chart to get this. Dry ships, for instance, is kind of a go-to stock these days. Almost every day. Again, this is a daily chart, a 6-month daily. I just zoomed in a little bit here with this Think or Swim software, which is, again, wonderful for this sort of thing. But every day, there's a gap in here almost. So we'll go a little bit slower. Here's the stock market closed right here. Next day had gap down, traded lower than higher, closed just off of its high. Opened flat. Next day it gapped up to there. Next day it gaps down a little bit. So these are sort of normal gaps for the stock, and they can be caused by any kind of catalyst or simply market behavior, especially if there's a specialist involved in a New York Stock Exchange or Amex stock. So 1, 2, 3, or 5 letters, unless it's a mutual fund, that make up a stock symbol. There's a specialist driving that very often, and that's good to know. So not a lot of energy there. Some opportunity, of course, intraday can be existent there, but I'd rather trade a gap out of a good setup. All right, so that's just normal kind of gaps, and again, they can mean a lot with regards to a good setup, and I've drawn some good resistance areas in here. It's neat to see the stock having trouble at the $100 mark, the century mark, and then also finding some support at the $50 mark here as well. All right, so anyway, that's a nice normal gap example. Let's go do an exhaustion gap. Again, I just had found some of these before. It'll take me just a minute to go and zoom back in. So put about a year up there, and I'll find it in a second. All right. It's a nice exhaustion gap right back in here. So after a beautiful run-up, and this is, again, a lot of people who know what they're doing won't necessarily jump back into a stock. There's also a nice continuation gap there. I'll go through that one too. Not a lot of people will just jump into a stock after many, many bars up in a row. So here's a stock day after day climbing higher and higher and higher. Then after many, many bars up in a row, and it's already extended away from the 20 MA, it's way above the 13, 20, and it's of course above the 50. Beautiful uptrend. All the moving averages are in line and rising. The stock then gaps up. All right, not very many people who know what they're doing will ever jump into and buy a stock at a nice gap up like this, because most gaps fill on profit taking. All right, so for whatever reason, a lot of good sentiment came into there. It could have been some kind of news event, but it did gap up, ran all the way higher, and then sold off, closing well off its high. That means that even the people who were day trading didn't want to hold on to that stock at night. They're like, better get out of this thing, protect myself, maybe ride the other half of the protective stop, and that can oftentimes cause a sell-off the next day. It can chop around, of course, and go up, down, or sideways. That's sort of an axiom, of course. But in this scenario, and it took me just a little bit to find one of these, the market did fill that gap, found a little bit of support there, and then fell out of bed. So just because the stock was doing well before, of course, doesn't mean it's going to keep doing well, and it's definitely not good to sit in something like that just to try to get your money back if you're upside down in it as well. So again, think about all the people who bought the stock up in here, who are now holding on to this thing all throughout this, just trying to get their money back. So there's a great bit of overhead resistance up in this area for this stock, and that would be true for very many exhaustion gaps like this. So again, avoid buying long after a multi-bar run up to the upside when most people are getting ready to sell and take profits after being in the trade for a long time. So if you're positioned well, that's a great time to take some money off the table. That's not a good time to buy a stock, because I now am fighting a bunch of sellers. All right, so that's exhaustion gap. I found a nice continuation gap here in KMX. Zoom back out, take me just a minute to find it. Alright, so this is a good one right through here. Same kind of scenario here, right? So this stock had been up very, very nicely, but instead of being extended, it's up 1, 2, 3, 4, 5, 6 bars in a row, chops around sideways, hardly any sell-off at all. Beautiful. So the stock has rested. It's pulled back into the rising 13 and 20. Then it gaps all the way up to here. And again, most people who know what they're doing are not buying new into that kind of position because they know that a bunch of profit takers are about to come in. But what happens when the people who are taking profits are met with immediate buying to cover from the people who are positioned not well, aka the shorts? They're not freaking out. They buy to cover quickly, they hold that stock up, and it continues up. But this is a hindsight play. I would never, again, buy long into the face of this nice gap up here unless it could take out the high that it put in the first 30 minutes of trade. And that's going to be the 30-minute gap strategy that people talk about. Alright, so nice support here day after day after day, and it works its way higher. That's great. It's a bit of a hindsight trade, of course, but sometimes you can get into those. So that's a continuation gap. You can find those a lot of places as well. Another good one is what they call a catastrophic gap, and I have a nice little go-to picture in my head of this one. So I'll put this back to a daily and I'll show you. Again, I don't have to preach at you about how good the market can be. So here's the market doing a nice job breaking out of its 200 MA here. A lot of overhead resistance. Stock would run up most likely to its next logical place of resistance, which in this chart would be this previous swing high back here. I thought I just dropped a line in there. Give me 1 second to put it in. That also corresponds with a pretty good sell-off back in here as well. Alright, so let's go through and see what happens as we tab through this. Nice resistance, breaks out of that even. Very powerful. Runs right up into the $100 mark. And this overhead resistance back in here. A lot of people hurt back there buying long into something when they shouldn't have. Then hold on to it and want to get out when it comes back. Again, that's the definition of overhead resistance. And then everything's looking okay. Boom, earnings. Sells off, opens right here. Goes all the way down. It's not over yet. Broken. Right? So this stock loses over half its value in just a couple of days, and it's damaged in a gigantic way. It actually never ever comes back from that. If you double click on this, get that chart back, there's the gap down, and it chewed its way down all the way to 46 cents now. Oh boy. So being on the wrong side of that for very long does not feel good at all. Always check news and earnings. They can deliver as much pain as they can good. And again, I'd rather not gamble with my money. So be very careful with that. Maybe in the future I'll throw together a nice video on what it means to trade a 30-minute gap strategy. It can be a great money-making exercise for intraday traders or for entering developing swing trades by getting a lower risk entry intraday. So very good. Just a quick little notes on some normal, exhaustion, catastrophic, and continuation gaps. And I hope this helps a little bit with your eye on the market. And again, thanks for joining us at freetradingvideos.com, and I'll talk to you soon.